If you're an investor looking for stable income, dividend stocks can be an essential part of your strategy. Now, I know today is a refresher course for some of you, but I also know that others of you have been more focused on growth rather than income. You know who you are. Okay, here's a quick review. Might be a little basic for some of you, but I want everybody to get caught up, okay? You can calculate yield by dividing a company's annual dividend by its stock price. Now, here's a current example of Apple, whose annual dividend is $1, and with the stock trading at $246.49, the yield is 0.4%. The higher the yield, the more income you receive from each share you own. All right, let's take a look at a few well-known dividend stocks, some of what are called the dividend aristocrats. Coca-Cola, for instance, has been a steady payer with a yield around 3%. Johnson & Johnson with a yield of around 3.38%. And Procter & Gamble at about 2.36%. Now, these stocks are reliable dividend payers that have consistently increased their payouts over the years. Now, notice the trend here. Dividend yields can fluctuate based on the stock's price. A stock's yield increases if the price drops, assuming the dividend stays the same. But be careful. Unusually high yields can sometimes mean potential risks or unsustainable payouts. That situation is called the dividend trap. So higher yield isn't always a good thing. Now, if you're looking to diversify, and you should be, you can also consider dividend-focused ETFs like the Vanguard Dividend Appreciation ETF. ETFs give you wider exposure to dividend-paying companies, and that reduces the risk of any one single stock. Now, one strategy to boost your retirement income is to reinvest your dividends. This can accelerate the growth through compounding, turning even small dividends into substantial returns over the long haul. In fact, keep this in mind. When you see the total return of an index like the S&P 500, that includes reinvested dividends. And don't forget that dividends account for more than 30% of the S&P's return historically, going back decades. Okay? So by carefully selecting dividend-paying stocks, not always going for the highest yielding investment, you can build a reliable income stream to help fund your retirement. Remember, dividend yield is just one factor in choosing investments. Think about it in the context of total portfolio allocation. Thank you for watching today. If you would like more tips on dividend investing and retirement strategies, be sure to like this video and subscribe to the channel. See you next time.